Hi everyone, my name is Afshana Afrin. I am the FR mentor at BeingACCA. I am an ACCA affiliate and a rank holder in SPR, All India Rank 2 and World Rank 6. I'm going to give a debrief of FR pre-December 2025 mock exam, and I hope that you guys have already attempted the paper before watching this debrief. And this debrief is just to clear your doubts and help you solve the questions easily. So I hope you attempt the paper and then watch this debrief. So let's start with the first question. This is section A, right? So they have given us a question about IS 36. A cash generating unit has the following carrying amount in Blue Post financial statement at 30 June 2007. Okay, and this is before allocation of impairment losses. And they're asking us to find out the carrying amount of the building after the impairment loss. So how do we do this? This is pretty much a direct question. And the only trick part over here is that they have given us the fair value less cost of disposal of the plant, right? So let's solve this. I'm solving on my spreadsheet. You can solve it on your rough paper or on the scratch pad which you get in your exam. Okay, so let's write down the values first. Goodwill is, goodwill is, okay, plant is given to us at 950. This is the carrying amount. Building is 1.3 million. Intangible asset is 400,000. And we have the net current assets, which is 430. Okay, when you add all of this, the carrying amount you're getting is 3.63 million. Okay, and the impairment which is given to us is how much? 113. Right, this is the impairment which is given to us. They have given to us 1.13 into thousands. Right, this is the impairment which they have given to us. And then we have to find the recoverable amount, which is nothing but just, right, this is the recoverable amount. Now over here it says that the plant had a fair value less cost of disposal of 1 million. Right, the plant, you can't allocate any impairment to this because we have the recoverable amount which is already 1 million, right? Now this impairment, the entire 1.13 million, first we will allocate to the goodwill, right? The entire amount of goodwill is to be written off. And then remaining impairment, remaining is how much? Is this much plus this much. This is the impairment which we have left over to be allocated to other items. And net current assets, we never impair this, so impairment is 0. Recoverable amount will be the same, right? So we are supposed to find out the ratio of building and intangible asset, and accordingly we will find out the impairment that has to be allocated to building. Okay, so building, we have the carrying amount of this much. Intangible assets, how much? 400,000. If you add both of them, this is the total. Okay, if you find out the ratios, ratio of building is how much? This 76%. Ratio of intangible asset is 23%, right? So the impairment for building will be nothing but the impairment which is left over into the ratio. This is the impairment of the building, and impairment for the intangible asset will be this much. If you sum both of them, you'll get the impairment which was remaining, right? So now over here, let's allocate the impairment to building, which is this much. So the carrying amount we are getting is 856,470. Right, the carrying amount of the building is the recoverable amount, or the carrying amount will be how much? 856,470, which is nearby. If you round it off, your answer is matching option number B. So your answer is B. Okay. This is a typical question on cash generating unit. Moving on to the next question. We have the IASB conceptual framework for financial reporting defines recognition as a process of incorporating within the financial statements an item which meets the definition of an element and satisfies the certain criteria. Which of the following elements should not be recognized? Okay, it's not asking the elements which you should recognize. Instead, it's asking the elements which you should not recognize. Okay, so you should be very careful when you're reading out the questions. Okay, which should not be recognized in the financial statements. So let's look at the options. Has a liability. It says that you can't recognize a provision for operating losses expected in next 12 months as a liability. Is this correct? Now, when we have a scenario where you are supposed to make a provision for operating losses, right? You are supposed to make a provision. This is compulsory. If your contract is leading to an operating loss, then you're supposed to recognize the provision for this. So it has to be, so a liability is to be recorded in a financial statements. Okay, so the option A is not our answer because this is a correct statement. Okay, next we have second, let's look at the third statement. The present value of the cost of decommissioning a plant at the end of its useful life. Now, this is also a correct statement because as per IS 16, at the date of at the start itself, you're supposed to find the present value of the cost of decommissioning, and you're supposed to make a provision, right, at the very start itself. So this is also a correct statement. Okay. Next is as equity, a rights issue of shares. This is very simple, straightforward. This is also a correct statement. So we are left over with option B, which is our answer. Okay. Option B is our answer. Now, why? Because it is saying that you can't recognize income for the goods you have delivered to customers for which payment is still pending, and the customer is responsible for any damage of the goods. Now, if you read, the customer is responsible for any of the damage, which means that we have already passed on the risk and rewards from the product, right? That means you can recognize revenue, you can recognize income. So this is not a correct statement. Even if the payment is pending, you have transferred the risk and responsibilities and rewards of the product. That means it's a revenue for you. So you have to recognize income for this, right? So this should not be recognized in the financial statements. Okay, moving on to the next question. Next, we have a question of IS 40, which is for investment property. It says that Brico owns land that was purchased on 1st January 2002 for 2 million, and the company initially held the land for capital appreciation, which means it was for the purpose of investment property to earn any sort of income from it. And on 1st July 2004, like approx 2 years after they have purchased the land, the company has occupied the land and began construction for its new head office, which means the purpose of using the land is no more just for capital appreciation, but then the company is going to use it for its own purpose, which is they're going to create a head office over there. So the usage of the land has been changed, right? So this is a classic scenario of IS of 40 in investment property to IAS 16 property, plant and equipment, right? And it is given to us that cost model is used for owner occupied buildings and fair value model is used for investment property. Okay, so how should BreakCo account for the change in use of land on 1st July? This is quite easy. At the date of 1st July, the fair value must be compared, and any gain or loss goes to statement of profit and loss account. Right. So we transfer the land from investment property to property, plant, and equipment. Right. If we look at the options, option number C is nonsense. Transfer the land from property, plant, and equipment to investment property. No, we are transferring from investment property to property, plant, and equipment. Okay. And then over here also, the fourth option, continue to measure the land at 2 million without any transfer. This is also nonsense. So last two options are wrong. Okay. So you're left with option A and B. So you're supposed to check which one is the correct one. Now over here, if you transfer from investment property to property, plant and equipment, any gain or loss should go to statement of profit and loss account because the company uses fair value concept for measuring the investment property. So here simply our answer is A. Okay, because on 1st July, the company will compare 2.5 million minus 2 million. So you have 0.5 million. This is the gain which goes to statement of profit and loss account. Okay. Moving on to the next question. This is a question of IFRS 16, question number 4. Now it says that the company has entered into a lease agreement to lease an item for 4 years. Okay, so lease term is how much? Lease term is 4 years. Right. Lease payment is given how much? 250,000. And useful life is 5 years. Ownership will be passed. So now over here it says that ownership will be passed to the company. Right. In this scenario, you should remember that if the ownership has been transferred to the lessee, then you're supposed to depreciate over the useful life of the asset, which means you won't depreciate over 4 years, but then you will depreciate over 5 years. Okay, this is a common mistake which everyone could potentially do. Okay. Moving on, the present value of lease payment is given, which is 750,000 present value of lease payment, 750, and interest rate is also given, 12.2%. Right. Simply, we will, the question says the total expense to be recognized. So just remember in statement of profit and loss account, we have one, which is the interest. Second, we have the depreciation. Right. How much is the interest? We have the present value of lease liability into 12.20%. So the interest for December 2004 is this much, and depreciation is nothing but present value of lease liability divided by 5 years. Okay, divide by 5 years. Why divide by 5 years? Because lessee gets ownership. So when you add both of the expenses, this is to be debited to statement of profit and loss account. So simply our answer is option B. Is that clear? Okay, moving on to the next question. It says that the company has purchased 10,000 shares on 1st September 2004, making the election to measure the item at fair value through OCI, right? Now, if a company is measuring through fair value through OCI, the company might sell or might hold the shares, right? and the transaction cost is always to be capitalized. Okay, we have got the transaction cost over here, $1,500, and they have given us the fair value at the year end. What amount should be recognized in OCI in relation to these shares? Okay, so on 1st September, how many shares you have? 10,000 shares. And what's the share price? 7.65. Right, so 10,000 into 7.65. This is to be capitalized. But along with this, you also have to capitalize the transaction cost, which is 1,500. So on 1st September, this is the amount you're going to capitalize. And record has a record for these shares on 1st September 2004. Now you're supposed to remeasure this at the year end. So on 31st December 2004, how much we have? 10,000 shares. What's the fair value now? It's 8.5, right? So when you compare this, you are getting a gain, right? Because earlier the value was 78,300. Now the value is 85,000. Okay, so how much is the gain? Gain is 6,700. So this is the amount which is to be recorded, which is 6,700. Okay. Okay, moving on to the next question, which is which two of the following criticism, right? Which means negative fact. The criticism means anything which is negative. Apply to current cost accounting during a period of inflation. Now, what is about current cost accounting? In this type of accounting, you're supposed to remeasure at the current cost, right? Which means you constantly have to upgrade your financial statements and make sure it's as per the current cost. Okay, so that's a lot of resources which we require because a lot of hard work is going on to update the financial statements as per the current cost. So we are supposed to point out the negative facts of this accounting principle. It requires frequent revaluation of assets, which can be subjective and complex. This is the answer. This is one of the answer. It may reduce comparability between companies using different valuation methods. This is also the answer because a company might use current cost accounting, other company is using some other methods. So this reduces the comparability. Next is it reflects the prices of assets prevailing at the time of consumption of asset. This is an advantage and it is less useful for decision making than historical cost of accounting. This is also a true thing, right? It is less useful for decision making than this historical accounting, historical cost accounting. That's true. But then criticism means negative facts. So option A and option B is a correct answer. Okay. Let's move on to the next question, which is about the refund IFRS 15 revenue. So over here it says 1st April 2007, the company has delivered a machine to the customer. Okay, delivered the machine to a customer. The machine was priced at 2,60,000. This is the price of the machine, and the customer had a right to return the machine for a full refund at the time, at any time, and up to and including 30 June 2007. See, now over here, this is a new customer, and the company was unsure whether they are likely to return the machine or not. Now, in this scenario, what happens is that over here, the correct answer will be option C because the customer has a right to return the product, right? And even if the company is unsure whether the customer will return it to us or not, you can't recognize revenue until and unless 30 June 2007 is passed, right? Because till that date, the customer has a full right to return. So option is that you make a refund liability and you have to debit receivables. So answer is C. Okay. Moving on to the next question. It says that on 30 November 2003, the company has purchased land in another country at a cost of 45 million euros, right? Over here, Keep a proper focus on the currencies used. Euro is given 45 million. What's this? Land. Okay, and land was classified as property, plant, equipment as per cost model. And at the year end, the company also paid 36 million euros again. Right, this is payables. And how much is left? The company still has 9 million euros unpaid payables, right? This is okay, this is total payables and 9 million is left over. Now, a quick revision as per IS 21 that land is a non-monetary item, right? Which means that at the date of, that means there's no change to the value, right? You don't remeasure at the date of reporting date or at the year end. But this is a payable, receivables, all are monetary items which you have to remeasure at the year end, right? And any gain or loss goes to SOPL. Okay. Okay, so it says that what is the carrying amount of the land and it payable on 31st December. So for us, the converted, you have to convert euro to dollars, right? So if you convert euros to dollars, you're supposed to divide, right? So land, how much? Land is 45 million dollars. Divide by the exchange rate on 30 November, which is 3. Right, $15 million is what the land should be recorded. Right, so your option answer is either option A or option C. And how much will you record the payable as? You have 9 million left, 9 million euros left in your financials, in your amount which is due for payment. That's on 31st December. So what's the exchange rate on 31st December? It is 2 euros per $1. So divide by 2. So $4.5 million is the amount which you're supposed to record the payable as at 31st December. So simply your answer is option A. This is your answer. Okay, at 31st December. Moving on to the next question. We have got a question on IFRS 5. On 1st November, the company held a factory with carrying amount of 10 million. Right? You have a carrying amount. What's the carrying amount? 10 million. Okay. Remeasured using cost model. Useful life given is how much? 10 years. You have to keep note of all these points when you're reading the question. So later on, you don't get confused. Right? And the company is aiming to sell the factory as soon as the major customer order was completed. Again, it says that the company will hold this as held for sale if the major customer order was completed. So can you recognize this as held for sale? No, right? Because this was expected to take at least 1 year, right? You can recognize as held for sale only if the management is committed to sell, can sell within 1 year, and in present condition, right? Over here, it says that it is expected to take at least 1 year, which means you can't classify as non-current held for sale because right now the company is not aiming to sell this. Simply the correct carrying amount of the factory will be the carrying amount, which is 10 million, less the depreciation, which is how much? 10 million divided by 10 years. Right, on 1st November they have done this, which is this much. So the carrying amount will be 9 million. Right, the carrying amount will be 9 million at 31st October 2006. You have to ignore all these statements. Why? Because the order is still incomplete, right? They are not going to sell it right now. They have a plan to sell after 1 year. So this is very irrelevant, and you just have to find out the depreciation and find out the correct carrying amount. Moving on to the next question. We have a question about IFRS 15 again. Okay. So over here it says that this is sale and leaseback scenario, and the company has owned a building with carrying amount of 21.6 million. The company has sold the building to a finance company for 36 million. So let's write over here debit cash 36 million. You have sold an asset, so credit asset of how much? 1.6 million, right? And then immediately entered into a lease and sale and leaseback agreement for 20 years. Remaining useful life is 25 years. And sale and leaseback agreement payment was 2 million payable annually in arrears. And the present value of lease liability is how much? 30 million, right? Credit, lease liability. How much is it? 30 million. You have to recognize a lease liability and a right of use asset. How much will this figure be? This will be nothing but the lease liability divided by 36 million, which is the cash sales proceed, into the carrying amount of the asset, which is 21.6 million. So right of use asset is 18 million. Okay. Now you can find out whether it was a profit or loss. Over here, if you sum this two, you're getting 54 million. If you sum this two, you're getting 51.6 million. So you're getting a profit. How much is the profit? Let's find out. The profit is of 20.4 million. No, sorry, this is 107. Profit is of 2.4 million. So answer over here will be 2.4 million. Okay, it says round off to 1 decimal point. So it's 2.4. If you by chance write 2.40, this is wrong. If you write 2.41, this is wrong. Okay, if you write 2400 again, or by chance if you write if you write the full amount, this is also wrong. Okay, you just have to write 2.4 million is already given. Moving on to the next question. It's about IFRS 15 again. No, it's about provisions. Okay. Now the company has sold washing machines with 1 year standard warranty as a part of its contract. As a part of its contract, which means there's a legal obligation. Why is there a legal obligation? Because it's a contractual item that it's written in the contract that a warranty for 1 year will be given. So we have a contract leading to a legal obligation. Right. So if you quickly go through the options given to you, option A and option C is speaking about constructive obligations. So you simply have to cancel out this. Right. You cancel out both these statements. You're left over with B and D has your answer. Okay. Now in the year ended 31st December, it sold 1,25,000 machines. So it says that on 31st December 2005, number of washing machines sold is 125, right? And in 31 December 2006, they sold 135, this much. Okay. Average of 8% machines sold need to be repaired. Okay. Total machines sold, repair needed. How many of them? Is 8%, right? Which means 10,000 machines in 2005 and 10,800 machines in 2006 need repair. Why? Because it's given 8% of the machines need repair. To be 50 in this much and 58 in 31 December 2006. If you calculate this, you can find out the provision. Now over here, if you see, provision required will be simply the number of machines that are to be repaired into the cost per machine. So you get a provision of this much, which is approx 500,000, right? And at the year, and at the 2006, your provision has to be 626,000, right? 626,400. What is the correct accounting treatment for the year ended 31st December? How much is the difference between this and this? We have an increment of this one. So in the year of 31 December 2006, you will basically credit the provision, right? Provision for warranty. By how much? By this much, right? Why so? Because earlier your provision was 500,000. Now your provision has increased by 1,26,400. So the correct answer is basically D. Okay. Moving on to the next question. Now over here it says that on 1st September, the company has sold an item of heavy plant to a customer for 4,06,000. Okay. And the plant was delivered on the same date. Now, if the plant is delivered on the same date, risk and reward is transferred to the customer, which means you can recognize revenue now, and out of which 50,000 has already been paid. So, how much is the payable of for this one? Payable, which means we have a receivable of this much, right? Which means More Co has a receivable of 410,000. Now over here, the company has given a customer with basically deferred consideration, right? Within 2 years, you can pay at a discount rate of 6%. Simply, you have to find the present value, which is nothing but 1 divided by 1.06 raised to 2. So this is the present value. So the revenue which you will recognize in financial statement will be the 50,000 which you received plus this figure. So your answer is 414,898. This is your answer, 414,899. Okay. Revenue which you will recognize is the 50,000 which you got and the present value of the amount you will receive in 2 years. Okay. Moving on to the next question. Then with question number 13. Over here, it says that on 1st July 2008, the company has received a 90,000 grant from the local government to support its expansion, and the grant was used to acquire a tractor costing 2,40,000 on 1st August, right? And the useful life is given of 10 years. So how do we record this in our financial statements? We have the statement of profit and loss account, in which we have 90,000, which is the grant amount, out of which you have to subtract the depreciation, right? Depreciation for 10 years, and we have to depreciate for five months: August, September, October, November, December, right? So this is for 5 months. 5 divided by 12, we have 3,750. So your statement of profit and loss account, this is the amount. In your statement of profit and loss account, this is the grant amount which you will recognize, 3,750. And in your statement of profit and loss account, what happens is that 2,40,000 which you have recognized, okay, and from there you have to subtract. This is the useful life into 5 divided by 12. So in your financial statements, this is the answer. Your answer in statement of profit and loss account will be 3,750, and in your statement of profit statement of financial position, your answer or the carrying amount of the tractor will be 2,30,000. So looking at all the answers, our answer is basically 86,250, right? It's presented as a liability with a carrying amount of 86,250. Our carrying amount will be this, right? And the statement of profit and loss account, we have 3,750. Okay. Option A is wrong because you can't recognize the entire 90,000 at 31 December itself. You're supposed to recognize over the span of 10 years. And grant income of 4,500 is also wrong because you're supposed to apportion it for 5 months. Right. If you don't do for 5 months, then your answer will be 4,500, which is wrong. Option answer is C. And option D is also wrong because the carrying amount will be 2,30,000 and not 1,44,500. Okay, moving on to the next question. We have question number 14, which is about intangible assets. In the year ended 31st October 2008, MCO has spent 330,000 to buy rights, to purchase rights to a soft drink formula. Okay, they have purchased something, purchased intangible asset. So you have to recognize it as intangible asset, right? And now you have to check whether you can amortize this or not. If the useful life is definite, then you have to amortize. If it's indefinite, then you have to check for annual impairment every year, and there's no amortization. And over here, it says that the rights were determined to have an indefinite useful life, right? Which means no amortization. Check for annual impairment review. Okay. Now, second item given is $12,000 to register its legal right to formula on the date it was acquired. It has no termination date. This is also an intangible assets for us because this is a necessary expenditure because you have to register its legal right, right? So this is a necessary expenditure and you have to capitalize as intangible asset. This is essential. Okay, and next it's given 45,000, which is a customer list and preferences. Now, if you remember, then as per our accounting standards, it's not allowed to recognize customer list as a intangible asset. So this amount cannot be recognized as intangible assets. Next is 1,50,000. It's to acquire technology on 1st July. Okay, and it says that useful life is 10 years, right? So this is the amount 150,000 we will capitalize as intangible assets less amortization for 10 years, right? So 150,000 divided by 10 years. How many months? Acquired on 1st July. July, August, September, October, November, December. Sorry, July, August, September, October, right? So that's 4 months. So amortization is this much. Carrying amount of the intangible asset will be 145,000. So final intangible asset will be the 3,30,000 plus the 12,000 spent plus 145,000. So intangible asset at the year end will be nothing but 487,000. 487, 1, 2, 3. Right, you have to write the entire amount over here to secure the 2 marks. If by chance if you write 0.487 million, this is wrong. If you write 487, this is wrong. Entire 487 and 3 zeros should be there for you to earn the 2 marks. Okay, moving on to the next question. It is about average co method and FIFO. This is a rarely tested concept, but we're seeing it being tested. Now, this is a high reminder for everyone to cover each and every chapter in your chapters should be covered properly, right? Don't miss out anything. Just try your level best to cover each and every chapter. Okay, so it's given on 31st December 2008. The company has changed its assumption. Change in assumption. This is IS 8. Right, changing accounting policy, accounting estimate, and prior period errors. Right, now they have changed from average cost method to FIFO. What's this? This is change in accounting policy. Why? Because there's a change in measurement. Right, recognition has changed. right? Presentation is changing. So this is change in accounting policy, and you're supposed to adjust it retrospectively. Okay. Now, if you look at the options, it says that just you know that it's a change in accounting policy. You have to adjust it retrospectively, right? So let's look at the option and cancel out all the nonsense answers, right? This is a change in accounting estimate and no prior year adjustment is required. This is nonsense because this is change in accounting policy. We cancel out option number D, right? Inventory, okay, this we can check later on. A prior period adjustment is disclosed. This is also nonsense because we are dealing with change in accounting policy. Okay, so let's solve this now. We are left with option A and option C. Let's solve this. It's given that in 2008, 2007, how much was the average cost? Right, 50,400 and FIFO was 52,100. So if we check, because of FIFO, the valuation has increased, right? How much is the increase? Before, if you value with average cost method, your valuation was 54,000. But with FIFO, your valuation is 56,400, an increase of 2,500. The same goes with valuation for 2007. The valuation was 1,700, right? So because of this, there's an increase in the valuation of 800, right? Right, so 2006 we have. Okay, so the average cost given to us, the increase is how much? When you use a FIFO increase, when using FIFO is an increase of 2,500, increase of 1,700, and in 2006 it's 52,500, and FIFO given is 55,100. So what is the increase again? Increase is 2,600. They're asking us for the cost of sales in comparative for the year end 31st 2007 31st December 2007, right? So this one minus this one, there's an increase of 900. When FIFO is used, COGS increases by $900, right? So our answer is option A. Okay. Okay, so that's it from my side. I hope this video was quite helpful for you guys. I hope that this was able to clear your doubts, and all the very best for your preparation. Thank you.